Welcome back to the course, A Brief History of Money, Banking, and Credit. I'm Edward J. Dodson, and this is Lecture 2 of the course titled Britain and Her North American Colonies. We need to remember that the population of much of the European continent was severely reduced by the bubonic plague, or Black Death, that occurred between 1346 and 1353. An estimated 50 million people perished, one half of Europe's population. One consequence for several generations thereafter was a great labor shortage. As trade across Europe slowly recovered, demand for commodities and prices for those commodities dramatically increased. At the same time, there was insufficient coinage available, causing prices to rise even more. Everything changed after 1516, when prospectors discovered in the Harz Mountains of northern Czechoslovakia a huge deposit of silver. Historian James Burke provides some details. He writes, at peak output between 1515 and 1540, the mountain was producing 3 million ounces of pure silver a year from its 135 veins, and the mint in the town was coining the silver as fast as the stamping machines would go. The coin they minted was called a thaler, a word from which the modern dollar comes. At the same time, the Spanish were extracting huge amounts of gold and silver from the Western Hemisphere. Over 100 tons of gold were extracted between 1492 and 1560. By 1600, over 25,000 tons of silver had been transported to Spain. The silver mines kept producing, and with investment in mechanization, silver production actually increased in the 18th century. Storms sank quite a few Spanish treasure ships to the bottom of the ocean. From just one of these ships, 40 tons of gold and silver has been recovered. How much more is there to be found? This keeps treasure hunters busy researching Spanish archives. Despite the fact that huge quantities of gold and silver were found and taken from the Western Hemisphere, very little, when coined, found its way to the North American colonies of France or Britain. In March of 1775, Edmund Burke delivered a speech in the House of Commons on, quote, conciliation with America, in which he praised the governance of British America as, quote, a wise and salutary neglect. For a century and a half, during which European rulers warred over control of North America, the colonists living in the British-controlled colonies relied on credit among themselves and from British merchants who provided goods the colonists could not themselves produce. The stage had been set for Britain's financial domination of its colonial subjects even before any settlements were established in North America. In 1565, Thomas Gresham provided funds for construction in London of what became the nation's Royal Exchange, or Bourse, to compete with the Antwerp Bourse. Gresham's original building was destroyed in the Great Fire of London in 1666. Rebuilt in just 3 years, the new structure also succumbed to fire in 1838. Gresham's contributions went even deeper, however, as he came to manage the English crown's royal debt in Europe's money markets. He was a strong proponent of maintaining a stable coinage, not only for debt management purposes, but also for keeping Britain's exports competitive. To solve the problem of escalating inflation in Britain, Gresham convinced Queen Elizabeth in 1559 to recall and remint all the silver coinage of England, which had become debased. The reminted coinage contained a much higher silver content. The plan worked and inflation came down. The basis for Gresham's analysis came to be referred to as Gresham's Law in the mid-19th century. Gresham had simply observed that over time, worn coins lost some of their metallic weight and content, so that their true value was somewhat lower than new coins. However, because the government treated the coin as having the same value, the worn coins were overvalued and the new coins undervalued. Thus, holders of coinage would tend to hoard new coins so long as old coins maintained the same purchasing power. Hence, the law attributed to Gresham stated simply that, quote, bad money chases out good money. Thanks in part to Gresham's influence over the nation's finances, Britain rapidly emerged as a major economic power. The island nation experienced the expansion of its port cities and a growing transportation network. Britain's manufacturers also sold their goods to Spanish and Portuguese merchants, adding to Britain's monetary wealth. At the same time, the increase in the global money supply caused an increase in the price of those goods, the supply of which could not be adequately increased to meet demand. More than any other commodity, Britain produced and exported woolen cloth. Thus, rather quickly, more and more land was diverted to the raising of the nation's some 11 million sheep. Beginning in 1651, the British Parliament passed the first of what became known as the Navigation Acts, which required that only English-owned ships carry goods into England and that their colonies in North America could only export their tobacco, sugar, and other commodities to England. These policies were key to the system of mercantilism. The need for self-reliance in Britain's American colonies stimulated settlers to establish a number of publicly owned banks. Pennsylvania Quakers were among the first to organize these institutions in an effort to serve the credit needs of their communities. What gold or silver coinage existed in the colonies was used to pay for imports from Britain. However, despite the trade restrictions imposed under Britain's system of mercantilism, the colonists engaged in a constant trade with the Spanish, which brought in Spanish dollars as the main form of coinage. Thus, during the colonial period, there was a serious shortage of money in Britain's North American colonies. The British government did not supply its colonies with sufficient coinage and prohibited the colonies from minting their own coins. The coins brought to North America by new arrivals were almost always spent to pay for supplies purchased from British or other European merchants. However, in 1652, Massachusetts challenged Britain's ban on colonial coinage, minting a series of silver coins. Silver shilling coins continued to be minted with the date of 1652, so that if the British learned of the coinage, Massachusetts authorities could claim they had not made any coins after 1652. Spanish, Portuguese, and French coins, acquired in trade with merchants in the West Indies and Mexico, were more widely available. Thus, the Spanish dollar became a standard unit of account, and the Spanish coin known as pieces of 8 was the most common coin circulating throughout the colonies. Throughout the 17th century, the colonists in Virginia, North Carolina, and elsewhere in the South employed tobacco leaves as a form of commodity money. Actual tobacco was later replaced by warehouse receipts, which could be used to acquire a wide range of goods or services and could be redeemed for the actual tobacco. Faced with a general shortage of coinage, or a universally accepted commodity, many colonial governments began to print paper currency, backed by the one asset the colonial governments possessed in abundance: land. Also, colonists who owned land could borrow the paper currency using land as collateral. In Pennsylvania, they were called bills of credit. By the 18th century, some colonial governments simply printed paper currency because they had no other options. The currency was used to pay for goods needed by the militia and circulated until used to pay taxes, at which time the currency was removed from circulation. Note what is written at the top: to counterfeit is death. In 1729, a then quite young Benjamin Franklin produced a remarkable analysis of the money issues with the title, "A Modest Inquiry into the Nature and Necessity of a Paper Currency." Franklin realized how important this authority by government to issue paper money was. He wrote, "A great want of money in any trading country occasions interest to be at a very high rate, and here it may be observed that it is impossible by any laws to restrain men from giving and receiving exorbitant interest, where money is suitable scarce." A plentiful currency will encourage great numbers of laboring and handicraftsmen to come and settle in the country. Now the more inhabitants, the greater demand for land, upon which it must necessarily rise in value and bear a better price. Franklin would a few years later begin to study the works of the great school of French political economists, the physiocrats. At that point, he would begin to understand that ever-rising land prices would eventually bring down an economy. But in 1731, he obtained the contract to print Pennsylvania's paper currency, which proved to be extremely profitable for him. The first paper currency had been printed by Massachusetts Bay Colony to pay soldiers who fought against the French. Other colonies followed. What gave this paper currency value was its use as payment of taxes and for other government services. One interesting characteristic of these bills of credit is that they had to be used by a certain date or they would have no value. In 1764, the British Parliament passed the Currency Act, prohibiting the colonial governments from issuing any more paper currency. The effect was to impose even greater hardships on colonial subjects and their governments and generate growing animosity toward the British government. Thus, in 1775, there were no commercial banks in the rebellious American colonies. Desperately short of coinage, that is, specie, each colony began to violate the Currency Act and issue notes. During the War for Independence from Great Britain, the Congress as well as the new state governments issued paper currency as needed. And of course, the Continental Congress began to issue continental currency in an effort to fund the war. The currency experienced continuous depreciation for two reasons. One was that it was not used for direct payment of taxes, since the Continental Congress had no powers of direct taxation. Secondly, the British flooded the rebellious colonies with counterfeit currency. Desperate to stabilize the exchange value of its currency, the Continental Congress agreed in 1781 to charter the Bank of North America, located on Chestnut Street west of 3rd Street in Philadelphia. The bank was chartered by the Congress in response to concerns raised by Robert Morris, Superintendent of Finance. The bank's functions and structure were designed by Alexander Hamilton. The bank was capitalized with loans from the Netherlands and France. In 1785, after the War for Independence was over, the bank's charter was repealed. Shares in the bank were issued and sold, 2/3 of which were paid for with loans from the French and Dutch. Thus, the bank was solidly capitalized with claims on deposits of gold and silver held in the Netherlands and France, as well as bills of exchange. With these assets in reserve, the bank began to issue new paper currency. Then, in 1783, the Congress and several states enacted legislation that permitted Americans to pay taxes with Bank of North America notes, establishing this currency as legal tender. Although the new Union of the States had no storehouse of precious metals to back its paper currency, the states did have that one usually valuable asset to offer as backing: land. And owners of land could be taxed if the land could be accurately valued. As Robert Morris explained in a letter he wrote in 1782, a land tax would have the salutary operation of an agrarian law without iniquity. It would relieve the indigent and aggrandize the state by bringing property into the hands of those who would use it for the benefit of society. The objections against such a tax are twofold. First, that it is unequal, and secondly, that it is too high. Others objected on the grounds that the right to own land was a natural right not to be interfered with by government by the imposition of taxation. With the end of the war and the economic instability that followed, the Pennsylvania General Assembly was pressured by the bank's debtors to revoke the state charter. The bank did continue to operate with difficulty under its congressional charter and also under a Delaware charter. Then in 1791, the First Bank of the United States was chartered for 20 years. This charter was renewed in 1816 for the Second Bank of the United States. President Andrew Jackson opposed the bank and ordered all federal deposits removed in 1833. The bank lost its federal charter in 1836 and ceased operations in 1841. The years to follow were dominated by a decentralized system of state chartered banks. In response, Nicholas Biddle, president of the Bank of the United States, began presenting state banks notes for redemption, calling in loans, and generally contracting credit. Biddle hoped that a financial crisis would generate support for the bank's charter to be renewed in 1836. The move backfired as the administration pointed to the dangers of a central bank that had sufficient power to disrupt the national economy. People were migrating to the vast North American interior. Currency and credit were desperately needed to meet the needs of the growing economy, and banking interests responded. After 1816, regulation of banks was left to the states. New banks were subscribed with some specie, that is, gold and silver coinage, but control over issuance of banknotes was often ineffective. Currency issued by the 700 plus state banks was discounted anywhere from 0 to 100% based on public confidence in and knowledge of the bank. Historians disagree on the effect of this period of minimally regulated banking on the growth of the U.S. economy. However, some years ago, Alan Greenspan stated in a speech that, more recently, some scholars have suggested that the problems of the free banking period were exaggerated. Retrospective analyses have shown, for example, that losses to banknote holders and bank failures were not out of line with other comparable periods in U.S. banking history. Which begs the question, has there ever been a period when money creation and banking in the United States was consistent with sound economic principles? The story is filled with many contradictions. One researcher, Edward L. Simons, wrote in 1984, in some states, particularly Michigan, where more than 40 banks failed before the system was declared unconstitutional, the system is better characterized as a fiasco than a failure. As the United States approached mid-century, the momentum for reform and for monetary stability increased. By the onset of the Civil War, state banks numbered 1,562. The National Banking Acts of 1863 and 1864 attempted to assert some degree of federal control over the banking system without the formation of another central bank. This was accomplished by creating a system of national banks, a uniform national currency, and an active secondary market for treasury securities to help finance the Union's war expenses. The result was that by 1870, there were 1,638 national banks and only 325 state banks. Freedmen's Savings and Trust Company was established in March 1865 to serve former enslaved persons and African Americans who had served in the Union Army. Abraham Lincoln signed the legislation for its charter just weeks before his assassination. By the early 1870s, the bank held deposits of $4 million, roughly $75 million today. Frederick Douglass served as the president. The Freedmen's Savings and Trust Company's all-white board of directors was headed by Henry Cook, brother of Jay Cook, whose banking firm had been instrumental in selling government bonds to fund the war. In 1867, Freedmen's moved from New York City to Washington, D.C. into a newly constructed building. Political influence allowed the bank's executives to make increasingly risky loans. And when a global financial crisis occurred in 1873, Freedmen's failed along with many others. Segregation stimulated the establishment of banks by African Americans following the dismantling of the Reconstruction era. Most of the 130 such banks were established throughout the southern states, with Virginia home to the largest number. Another major controversy surrounded the roles of gold and silver, not merely as the content for coinage, but as backing for the issuance of paper currency. Legislation passed in 1873 embraced the gold standard and demonetized silver. Mining interests and Westerners fought against this measure because gold was scarce in much of the country. The debate over whether currency ought to be backed by one or more precious metals, gold, silver, or both, that is, bimetallism, became an important political issue during the last decades of the 19th century. In response to a serious problem with counterfeiting of paper currency in China, the Ming Dynasty adopted silver as its legal tender. Between 1600 and 1800, the Chinese received 100 tons of silver on average per year. Although a vigorous trade existed between U.S. and Chinese merchants, Chinese exports, tea and silk, the two main trade items, were far greater than their imports. Silver completed the exchanges. One outcome is that in the United States, gold gradually replaced silver as the mandated backing for most currencies. However, the proponents of silver managed to convince Congress to pass the Sherman Silver Purchase Act of 1890, which required the U.S. government to purchase millions of ounces of silver. However, the government paid for the silver bullion with gold notes. The result was a run on the U.S. Treasury's gold reserves, helping to trigger unrest in the financial markets and the Panic of 1893. Re-elected to the presidency, Grover Cleveland engineered repeal of the act. Nothing was really solved, and the stage was set for an even more serious financial panic and economic crisis to come. Surviving state banks responded by offering customers checking accounts as a substitute for bank notes. As a result, by 1890, only 10% of the nation's money supply was in the form of currency. Combined with lower capital and reserve requirements, as well as the ease with which states issued banking charters, state banks had again become the dominant banking structure by the late 1880s. The debate over bimetallism was far from over. The Westerners found their champion in William Jennings Bryan. Campaigning for the presidency in 1896, Bryant delivered his famous "No Cross of Gold" speech, in which he declared, "If protection has slain its thousands, the gold standard has slain its tens of thousands." Bryant campaigned vigorously but fell short. William McKinley had long defended protective tariffs as essential to U.S. prosperity and the high wages of U.S. workers. McKinley also defended the gold standard. Even as the end of the 19th century came and went, the world's great commercial power remained Great Britain, which for nearly 2 centuries settled any trade imbalances with gold. Germany followed suit in 1871, and the United States conformed in 1873. By 1900, only China and a few Central American countries held firm to a silver standard. Inaugurated president on the 4th of March, 1897, McKinley promptly called a special session of Congress to revise customs duties upward. He eventually signed the highest protective tariff in U.S. history to that time. In the presidential election of 1900, McKinley once again faced and defeated William Jennings Bryan, this time even more convincingly. While on a speaking tour across the nation, McKinley was shot by an anarchist on the 6th of September 1901 and died a week later. Theodore Roosevelt became the next president of the United States. Roosevelt faced many enormous challenges, not the least of which was the fact that immigration had doubled the population of the country since 1870. Along with industrialization came overcrowded cities, substandard working conditions, and a worsening concentration of income and wealth. Roosevelt put his faith in government regulation to secure the public welfare. For a nation largely dependent on coal for power, a strike by Pennsylvania coal miners in 1902 threatened to bring the economy to a standstill. Roosevelt threatened to nationalize the mines, which brought the owners and labor unions to the negotiating table. This was the first phase of Roosevelt's square deal approach to solving domestic issues. Beneath the surface, the U.S. economy was plagued by systemic weaknesses, the absence of law to effectively prevent monopolies. Roosevelt pushed for initiation of a lawsuit against Standard Oil in 1906. Other initiatives failed to secure the needed support in Congress. The consequences of decades of inaction were on the horizon. And that brings us to the end of Lecture 2.